a couple minutes before we get started here. Okay, let's run it. All right, everybody, welcome to another round of SMIC and REA collab. Again, it's always a pleasure to work with that team. They're very, very kind, and they love to see Cal Poly get a little bit better at making these kind of connections. So we have an interesting opportunity today to speak with Matthew Guerra, and we'll first get into some announcements before we kind of turn it over to him. So if you haven't gotten connected with SMIC yet, you can go ahead and scan this QR code if you're interested in any of our Linktree offerings, which we have our Slack or LinkedIn or Instagram, YouTube, you name it. Go ahead and scan that link, and we also can drop the Linktree and sign-in sheet in the chat right now if you're here for extra credit, or if you want to get connected to any of our Linktree socials. So next week is spring break, which is really exciting. Hopefully, you guys can get some downtime, or, if you're SPC, definitely, hunker down on doing some SPC work. But after that, we'll be hosting a CFP, which we haven't had this semester yet. We've had one or two CFPs last semester, but that's a gentleman named Casey Bartels. And he will be kind of going over kind of a lot of financial literacy, setting up 401ks and whatnot. So definitely tune in for this guy. It'll be very interesting. A little bit more on SPC this week. Some of the key deliverables are going to be conducting that financial analysis. We're going to start deep diving companies' financial statements. We're going to be looking at key financial ratios, and we have an awesome template to fill out. And what those ratios help us do is kind of summarize the financial condition. Use what we have done and kind of analyzing and researching what the company is and what their plans are doing. We're going to merge them with these ratios to make sure that we get a full story and see how these ratios can make sense. And then after, we're going to develop these valuation models. And over spring break, it'll come full circle. You're going to have the background research. You're going to have what the company's objectives are. You're going to know the different risks, and you're going to be able to write that report with the valuation models and target price. So definitely awesome. Make sure you're keeping, good connection with your mentors so we can get that full circle story going. So I'll turn it over to REA for some announcements.
So if you haven't already, you can follow us on our social media platforms to get connected with REA. And if you want to be more involved in the club, you can join our REA Slack, which is where we post our resources, announcements. You can directly private message like the e-board. So it's super helpful to get connected with us through Slack. And we also have a YouTube channel, our Instagram, where we post every single week. So you could be updated with our events.
Thank you, Heidi. I'm dropping the REA sign-in right now. So just some recaps on events we had previously and what we're going to have. Last week, we did have a real estate investing and wholesaling talk with Avenue One Capital. Really interesting conversation. Today, of course, we're having a SMIC collab. And then this week, we're actually doing two events. So on Thursday, we are going to have Crystal Levis, who is a National Accounts Manager for Commonwealth Land Title Insurance. And for those of you who have been hearing me talk about this opportunity again and again, she is one of the connects that talked to us about a job offering there. So please make sure to come, and you can ask questions about it. Next week we have spring break, and then we are still determining what we're going to have April 7th, but stay tuned. And another thing is our partnership posting. So as some of you may know, Crew Inland Empire is awarding 30 female identifying students with a $5,000 scholarship. And you're not only given the funds to further your real estate career, but you're also given an opportunity to network with really amazing industry professionals. And you get offered a 6-month internship or a little work study type of thing where you get to shadow one of the professionals. On top of that, I really want to emphasize this is a really amazing chapter. Caitlin and I won it last semester, and they have been nothing but kind to us. They're always inviting us to events, always reaching out to us. So definitely would recommend doing that. It's due April 15th, and I'll put the posting in the chat right now. And the next slide. And then also this is our job posting from Commonwealth Land Title Insurance. It's a commercial sales exec job, and Crystal's going to talk about it more this week. But Fidelity National Financial is like one of the largest group of title companies and title insurance underwriters. And it's just an amazing opportunity. She's looking for a recent or soon-to-be graduate who is interested to working with her in the Ontario, California office. I posted a link for the job posting as well as an email that you can email your resumes to her too. And basic netiquette is, we really appreciate everyone joining us. Without you guys, we wouldn't really be running clubs. We wouldn't really have anyone to talk to about what we're interested in. So, just to get the best out of the presentation, respect our guest speakers' time and also, ensure that we have enough, we get the most out of it. We would appreciate if everyone could keep their questions to the end and any comments to the end, just so we can get through the presentation faster or in a timely sense. On top of that, please use the raise hand function during the Q&A section. This just ensures that we can get through everyone in a proper order. And Zoom fatigue's real. Sometimes I don't feel like having my camera on or talking. So if you don't want to raise your hand and speak, please use the chat function, and someone from the e-board will unmute themselves and say, hey, so-and-so had a question or comment, and we'll get to you that way as well.
All right. So I guess now for the main event, I can quickly introduce Matthew, and then I'll turn it over to him. So Matthew Guerra has been active in commercial real estate since 2016. Has played a role in analyzing multifamily investment properties and helps clients reposition multifamily assets for wealth generation to maximize retirement income. So Matthew began with Growth Investment Group, and over the years, he's transacted over 38 million in sales of apartment complex throughout SoCal. So once starting at Principal Quality Investments, Matthew continues to work on sourcing coveted off-market value add properties, allowing partners to benefit by participating in the investment through the vehicle of commercial real estate syndication. So Matthew, feel free to fill in any gaps in your own bio, but we'll turn over the presentation to you now.
All right, thank you, Andrew. So I'm gonna go ahead and share my screen, and let me know if you are able to view it.
Yep. Looks good.
All right, so my company is Principal Quality Investments. We're a commercial real estate private equity firm. And a little bit about myself, I actually began in real estate in 2013-ish, kind of by luck, actually. My mom was going through foreclosure, and luckily I met somebody that was able to help us save the home. So I felt really compelled to, spread the good information that I learned, and the person that helped us just wanted me to be able to pay it forward. So I joined a local real estate investment club, and I learned about real estate and wholesaling. And so I saw that you guys are learning about wholesaling. For anybody that's not familiar, you're basically getting a property under contract, and you're assigning your rights as the buyer to somebody else for a fee in between. So my very first deal, I made a whopping $450. I was super excited about it, and I always had the idea of residual income and owning apartment buildings. So I went out, I got my license, and I joined a local boutique commercial real estate firm. And I started as a commercial agent selling multifamily properties. So I sold as many as 49 units at a time, over $10 million, as little as 2 units at a time. One really valuable thing that I was able to learn, of course, sales skills and how to analyze multifamily properties, but I began to see certain trends in the market. And some of these trends were that there was a smaller group of people, 1 to less than 5 people that own thousands and thousands of units. And so the way they did it is they pooled their resources together to go out and purchase these larger properties and execute on the management of them, and sell them for a profit later on. And so that's how I kind of got into the private equity side. So I found a property for 1.8 million. The buyer at the time was raising $2 million. And I was able to become an investor in the deal because I found the property. And we ended up purchasing 3 different assets in the same city. And the property that we found for 1.8, we sold it in under 3 years for 2.7 million. So that was my first taste of being on the principal side of the business instead of just an agent. And so shortly after that, another partner in mine, we found a student housing property for 1.5 million. We used creative financing to get into the deal. So we only put 40,000 and projected exit prices over 2.3 million. So, I've really been able to find unicorns in this space. So it's what we're doing now is we're launching our first fund, Pqi Growth Fund 1. We're currently raising $10 million to go out and purchase multifamily properties throughout the nation now. And right now we have about 900,000 of capital commitments since early February. So there's 2 ways that investors get paid with us on these deals. Number 1, through the cash flow, and then number 2, through the profits once properties are sold. So, the benefit of real estate is you get short-term income through cash flow, and then you get long-term value appreciation through profits. So the rule of 72 says that if you get 14.3% return on your money, then you'll double your money every 5 years. So that's what our goal is for our investors, to double it every 5 years. So that's what the 2x multiple is. And that's what our targets are for a fund. And in my experience, real estate is a really amazing hedge against inflation, because in an inflationary environment, the cost of goods and services are going up, the cost of rents are going up, the cost of assets are going up, and that your debt level stays the same. So essentially you're paying today's debts with tomorrow's dollars. I often say that commercial real estate is the ideal opportunity, and the I stands for income. You can get anywhere from 3 to 12% cash on cash return just from the income from day one. The D stands for depreciation. We all know there's huge tax benefits like depreciation for owning real estate, and it's a tax shelter. It provides a tax shelter that other investments don't. The next is the diversification of it. So you can diversify not only between asset classes from industrial, multifamily, retail, self-storage, but you can also diversify between cities, from Los Angeles to San Francisco to states, from California to Florida to even different countries. So you can really diversify just within real estate. And then of course you get equity in the deal and appreciation. Now the difference between residential and commercial is you can force the appreciation. So as your rents are going up, as you can drive your expenses down, it's going to be based, your NOI goes up, the cap rate stays the same. So essentially you're forcing the appreciation on it. And last is leverage. You can get growth using other people's money. You can borrow 4 to 6% and get 18 to 20% returns on that. So here's some typical general partner fees for somebody who wants to be a general partner. Typical fees are acquisition fee for finding the deal, for sourcing, for underwriting, all that, anywhere from 1 to 2% of the acquisition, the price of the property. An asset management fee from 1 to 2%. That deals with the SEC guidelines, all the compliance that goes involved with raising capital. Disposition fee once the property is sold, and a loan structure fee going through the refinance process. So there's a lot of fees that somebody can charge. And then the equity, you can get anywhere from 20 to 70%, of course, depending on the promote and the carried interest structure that you want to present. So here's a typical cycle investment process. And really all of these take specialized knowledge to be successful, from buying the property Learning how to find off market opportunities, learning how to deal with brokers, sellers, the list goes on. Renovating, learning how to deal with vendors, contractors, and knowing what needs to be done. And then, of course, the management of it, from the raising the income, stabilizing it, the whole operations aspect of it. Of course, there's the compliance aspect of raising capital, SEC, the legal that goes into it. So this is it takes quite some time to get good at all of it. And here's some interesting trends that since I've been in the industry, what I found is that there's a lot of institutional firms, private equity firms that are looking for good talent right now, for people that can underwrite, analysts, associate positions. There's a lot of capital, of course, in the space, anywhere from sovereign wealth funds, family offices, life insurance companies, a lot of capital chasing the deals right now. And then there's a real emergence of niche markets like, crypto, DeFi, build to rent SFRs. 40% of the housing stock in America now is owned by investors and not by people that actually live there. Of course, tokenization of real assets, and the migration from urban cores to tertiary markets. And there's a huge, huge investor appetite. The Reddit community, Coinbase, Robinhood, Acorn, all the crowdfunding platforms that have come about, there is a really big opportunity for a fund manager or for a private equity firm to really capture a lot of retail investors and to be able to onboard them to become clients with their fund, to be able to add value to them. And there's a huge demand for people looking for opportunities. So what's the downside? In my experience, it's long hours, especially like in an associate role or acquisitions role with the firm. I have a friend, she's putting in 90 hours, a week as an associate. There's a steep learning curve as well. And if you're a startup like myself, you need plenty of cash reserves to be able to support yourself until you close your first deal. And this is not an industry where you can clock in and clock out. It's a 24/7 growth mentality. I personally love it, but it's not something where you can just clock in and clock out. You're constantly checking for, on the market, seeing what's going on. You're constantly looking for trends, looking for ways to minimize your risk. And then, of course, there's uncertainty, in the startup of when you're going to get your first deal if you're a startup. These are reasons that I found to really, what I love doing most about my work, finding great deals, analyzing it, putting it in spreadsheets and really number crunching. Then I also love the problem solving of being able to see an asset and see where is the value that can be had here? How can we turn this around? How can we, make this fit our model? Of course, meeting high net worth individuals is really interesting, really fun, being able to see what their backgrounds are, what their experience is and how they view the world. And then acquiring the knowledge, just like I said earlier, like growing, listening to podcasts and constantly growing your knowledge, the time freedom to be able to, go on vacation, random note it, just spontaneously and things like that. And of course, there's unlimited, financial rewards. There's no ceiling in this type of industry. So, but yeah, that's pretty much it. So I'll go ahead and open it up for questions.
Sure. Yeah. I mean, I think it's really interesting snapshot on both fronts. We have SMIC that, we, work hand in hand with the university's student managed investment fund, which is, it's funny because, in our real estate, allocation, our portfolio, it's around 2.5%. It's kind of like, hey, let's just invest in whatever's hot in the market. We haven't looked even, more deep into that. So I was hoping you could talk a little bit more about, maybe because you mentioned PQI kind of, growth fund, right? Are you looking to put something together for, private equity?
Yeah. So Pqi Growth Fund we're in the process of soft commitment stage right now. So we have 900,000 of capital commitments, and that's as of early February. And we're looking to go out and purchase value add opportunities throughout the nation. And that's kind of, where we're at right now.
No, definitely. No, and I think too, and everybody, feel free to ask, a bunch of questions as well. But I'm, it's funny because you started at your kind of first position and you're like, okay, well, I'm pretty good at this. I think I'm going to start my own firm. So maybe if you could walk through a little bit more on kind of more of the, that one slide you're saying, okay, it's not easy. You got to spend a lot of hours, maybe kind of start and kind of, tell us a little bit more about, how you actually got it running and how, do you have any employees, kind of what's the whole day-to-day look like for you in a way?
Yeah, so great question. So, yeah, it's definitely not easy. There's still the uncertainty, and you definitely need to have the cash reserves to be able to sustain yourself. Luckily, there's in this type of business, there's not a whole lot of overhead. Most of the overhead goes to software systems and basically software systems and marketing systems to be able to go out and capture different leads.
So it looks like we have a question from John Garcia. So if you want to unmute yourself, John, feel free to kind of ask your question. If not, I can say it for you. All right. Well, John's asking how much capital is needed to get started to become, kind of a partner, for, PQI, for example.
Yeah. So every firm is going to be different. And like, for example, the typical industry norm, if someone's going to invest alongside us or another firm, is anywhere from 25 to 50,000. That's kind of like the typical norm. The downside of that is that most likely you have to be accredited investor. Accredited investor is someone that has a net worth of $2 million, and it does not include their personal residence or $200,000 per year income. So there's not a lot of people, especially younger people, that have that nest egg built up yet. So the way I was able to get started was I found that property for 1.8 million, and I said, hey, you know what? I found this property. Do you mind if I become an investor, alongside you guys? And they said, yeah, of course, we're more than happy to do that. So that's kind of how I got started.
So it looks like we got a question from Andrew. Andrew, if you want to go ahead and ask and unmute yourself. Introduce yourself first, of course.
Yeah, sure. Hey, I'm Andrew. I'm a third-year finance student. I was just wondering, so you have $900,000 committed to your fund, and how do you plan on getting more investors? Like, how do you pitch them? Is it like previous deals? Like, how do you find them too?
Yeah, great question. So far, like that 900,000 are previous deal contacts, people that I've actually helped sell their multifamily assets or that I've built relationships with over the years. And right now we're actually in the process of reaching out to other accredited and non-accredited investors through different sources. Like I said, a lot of the money goes into being able to find those different leads and lead generation and things like that. So, we have different lists that we go through and we target those people and basically just pick up the phone and have a conversation with them, see what their investment criteria is, what type of deals they're looking for, if it's maybe they're not even interested in real estate, but if they are, what type of real estate. Some people might be interested in self-storage or industrial. Some people really like the idea of investing in California. Some people really don't like the idea of investing in California. So it's just picking up the phone and making those contacts. And it's always better to do it before you need the money, before you actually have a deal. So you're building those contacts and say, hey, I don't have a deal yet, but in the future, 3 months from now, once I get something, would you be interested?
Got it. Yeah, thank you.
Looks like we got a question from Sonica. Go for it, Sonica.
Hi, Matthew. Thank you so much for coming today, talking to both REA and SMIC. One question I had was about the ideal opportunity thing that you were talking about, and I thought that was really interesting. So I guess, like, I have a kind of two-parter question. The first question is, how did you come up with that idea, like the mindset of ideal opportunity? And, if you could go more into how you do your leverage aspect and what does OPM mean? I think that would be really cool.
Yeah, great. So the ideal is not actually something that I came up with or that I phrased. It's a friend of mine who always talks about it, and so I was like, wow, that makes a lot of sense. So that's where the ideal came from. As far as the OPM, that just stands for other people's money. So in the way that I frame deals is, if I'm looking at a property for however many dollars, I'm looking at, obviously we're going to put leverage on the property, as much leverage as we can, anywhere from 70 to 85% leverage. That would be traditional. And then with the remaining equity that we need to contribute, we would raise that equity. So if we're getting traditional bank financing for 70% on a commercial property, that other 30%, maybe I don't have it all by myself, but that would, me and 3, 4, 5, 6 other people do have that. So then we'll raise capital that way, and we'll, crunch the numbers to see how it makes sense and the type of different splits that we'll get to be able to get into that deal, so that we can operate it, manage it correctly, and then, exit and everybody get paid.
Really cool. That's your friend came up with a really cool idea. Thank you.
Okay.
It looks like we got Michael. Michael, go ahead and introduce yourself.
Hey, Matthew, thanks for coming out. My name is Michael. I'm part of the SMIC Club. We really appreciate you coming. I did have a question on what are some of the ways you like to, or strategies to diversify your real estate portfolio if you do only specialize in one certain type of real estate industry?
Yeah, so my specialty is multifamily. However, what I've seen is a lot of people that maybe their specialty is self-storage, but that doesn't mean that they won't be a limited partner alongside me and my fund in multifamily, or vice versa. If I'm specialized in multifamily, I might allocate a certain amount of dollars to their fund, to be in self-storage that's in a completely different location than where I'm focused. If I'm focused in California, I could have a certain amount allocated towards self-storage or an industrial in the Midwest, or in Florida, or anywhere else.
So like location's a pretty big deal, in terms of diversifying just one type of asset.
Yeah, correct. So that's a really good thing. You can diversify between different asset classes, and then you can diversify in between different locations also.
Right on. All right. It looks like Marvin, you got your hand raised. Go ahead and introduce yourself.
Hey, Matt, thanks for coming. My name is Marvin. I'm part of the real estate club. And you mentioned how there's like a 24/7 growth mindset and long hours working at the startup. And I was just wondering, what are some of the biggest learning curves? And maybe any advice you have for anyone trying to start a similar career path as yours?
Yeah, so definitely a 24/7 growth mindset. Some people might not like that. So if they don't really like it, it might not be the right industry choice. But if they do, then I think it's a great industry choice. If you're joining like an established firm, like a larger firm, then you can, as an associate or an acquisitions analyst, then you can expect really long hours. Like I mentioned, my friend is doing 90 hours at a pretty big firm, a pretty well-known firm here on the West Coast. And so, yeah, they're doing really long hours. And then as far as the learning curve, it's really getting good at the numbers and really getting good at being able to not only data entry and, plug in, numbers into a spreadsheet, but, seeing why, are you plugging those numbers into a spreadsheet? What are the trends that you're seeing, when you're going through the rent roll of the property, or through the income that it's been bringing in, and being able to see a trend through those numbers. So that, and then also just learning the industry as a whole, like why one particular property is more desirable than another when they're right next to each other and they could be the same size, same amount of units, but what's the difference between A and B? And you'll kind of know that over time between dealing with different investors and different buyers and seeing trends that way as well.
Great, thank you.
Right on. We can move over to Naaman. Naaman, go ahead and introduce yourself.
Hey Matthew, my name's Naaman. I'm part of the SMIC board. Thank you for taking time out of your busy schedule to come talk to us. We really appreciate it. And just a question I had was, since you're based in California and a lot has been changing in California since the pandemic, have you seen any trends that have affected your business in the past few years? And if so, could you mind describing them to us? Thank you.
Yeah, I couldn't really hear you too well, Naaman, but if I understood the question, it was that you're based in California, and are there any trends that I've seen being in California as well?
Yeah, exactly.
Okay, yeah, so of course, everybody hears about the migrations from urban cores into tertiary markets. You know, I personally have seen that happen. I've seen, I know a lot of people that have moved out to like Texas, Utah, Arizona, you know, different states like that. So there definitely is a migration for that, and there are definitely investor mindset fears when it comes to investing in California. So if somebody's not familiar with the market, you know, they might say, hey, you know what, it's too crazy there, you know, because of A, B, and C. So, you know, I'm not really interested in investing in California. That's okay. You know, but the people who are probably local here, who have experience investing here, they're like, well, those are true. However, if I were to purchase, let's just say, for example, a shopping center in Arizona or in Dallas, I'm competing with all the raw land that's around there, where somebody else can put a brand new shopping center a block down the street or apartment building block down the street. And then there goes the value of my property. They're stealing all my customers and my tenant base. So it's kind of, there's pros and cons of being here, definitely just like anywhere else.
Perfect. Thank you so much.
Yeah, I guess like a little comment, like you're saying, like just you're fleeing one risk into another, right?
Right.
Yeah. All right. So we can swing it over to Victor. Victor, go ahead and introduce yourself.
Hi, Matthew. I'm Victor Meneses, and I'm the vice president of the Student Investment Club. And you just mentioned something about investor fears, and I was just wondering, with like the idea of rising interest rates, when you're investing into like multifamily homes, are there any benefits or downfalls to a period of rising rates?
Yeah. So definitely, the fear or the downside is that there's going to, but with rising rates, there's going to be less of a demand, right? That's why rates get risen to slow the demand out. So there is that demand. However, there's really not enough housing stock for the amount of people that we have here in Southern California. So there's just, we need to build over 800,000 new homes over the next 7 years just to keep up with the demand that we have here. So going back to if you invest, you know, in a more rural area out of state, there could be a new property that comes and offers lesser price to your tenants, and they can have a brand new building with the same rate or less rate, you know, down the street. Well, if you have something here in, let's just say, Los Angeles, it's really hard to build, you know, new product here. And so you do have higher rates that present a risk. However, there's just so much demand here, so it doesn't affect it as much.
All right. So we can move on to Jerry. Jerry, if you want to mute yourself and go ahead and introduce yourself as well.
Hey, Matt. I'm Jerry, a member of SMIC. I appreciate you coming over to talk. It was a really interesting look at the real estate industry. So I noticed in one of your slides, you mentioned green buildings. And I'm thinking because of like the increasing prevalence and awareness of sustainability in the customer base nowadays, what might be one of the driving, or what might be a few of the driving factors that could cause you to invest in say, renovating an existing building to be more sustainable versus investing in like a building that's been built from the bottom up with sustainability in mind?
Right. So it's not so much that I would necessarily invest in it, but it's more of the fact that there's a lot of institutional capital investing in green buildings and trying and have already made pledges to reduce their carbon footprints. Companies like CBRE and Brookfield Asset Management, Blackstone, these are all huge companies that are promising or pledging that they're going to reduce their amount of carbon footprint. So that's a trend that's only going to get bigger and bigger.
Thank you.
Yeah, it's definitely we've seen that too in like big ESG shifts, and you have a lot of investors saying, I really don't care. But some, I guess, for kind of credibility points, you have to move with the herd, right? So that's interesting that you brought that up, Jerry. Yeah, David, go ahead and unmute yourself, introduce yourself, and ask what you need.
Yeah, thank you. Hi, everyone. My name is David Leon, and I'm the Director of External Affairs for REA. And you kind of touched on it a little. I wanted to know, how are you preparing in the event of a market change?
Yeah, so great question. The number one thing that we do to prepare is we acquire, 70 to 60% below market value. So even if there is a dip in the value of pricing, then we still have that 30 to 40% hedge. So that's what we look for from day one.
Thank you.
So is it like 70% of the actual market value is what you're willing to pay for something? Is that like only the equity portion of it?
Of the actual market value. For example, we're looking at a 4-unit property right now, and as is, it's probably worth close to $1 million, and we're going to be getting it for $700,000. So, and that's as is. So once we, make improvements and different things like that, we're going to be able to push the value even higher. But this is we want that buffer from day one.
I mean, how are you gonna get the sellers to agree to sell it 30% below what they think it's worth? I mean, that's a great question from David.
Yeah, so those again are unicorns that it's just really a numbers game at that point, where you're going through so many potential deals to find that one that makes sense the most.
Right on. All right, I think we move over to Joy. And introduce yourself.
Hi, Matthew. Nice to see you. My name is Joy, and I'm part of the SMIC club here. And so I just have a quick question on tokenization. So earlier you talked about that niche market, the idea of that, decentralized finance and cryptocurrency. So in my impression, tokenization is kind of like you transform the real world asset into like digital tokens on the blockchain. And so I'm just wondering, like, how does that play a role in real estate market? What are the benefits, what are the disadvantages, and what's like the future of this?
Yeah, it's an exciting, it's a very exciting trend. I believe it's the future of real estate as we know it. You're already seeing, you see crowdfunding sites where somebody can go in and invest $500, with Fundrise or CrowdStreet, these other platforms, and that are open to non-accredited investors. And with tokenization, you can really take an asset and sell it off to individual investors through STOs, through security token offerings. So there's a company already that's doing it with their funds, Red Swan CRE. They've already tokenized their fund of assets. There's already been actual assets like a hotel in Denver, Colorado, or Aspen, Colorado, that's already been tokenized. So I think more and more you're going to be able to see property, just individual property owners that has a house and they want to sell it for, let's just say $1 million, but so they're going to tokenize it and build all these shares of that house, and then it's only going to take $1,000 to be a part owner of that house. So it's really exciting, and I do see it continuing to to get bigger and bigger.
Cool, thank you.
I don't know if it's a joke, but if we want to talk a little bit about metaverse too, now that's moving. But I mean, I guess, part of, moving in the token space too, some people joke around with like, oh, buy meta real estate as well, right? I mean, that's a whole another discussion as well. So I think we'll go ahead and move the floor to the Lawrence. Lawrence, if you want to introduce yourself and also kind of ask a question.
Yeah, hi Matthew. My name is Lawrence, and I'm an incoming intern for Matthew's Real Estate in in Costa Mesa. And my question is, so I work with a lot of agents who does like industrial, and we spoke a lot about multifamily too. And in recent years, multifamily and industrial are booming really fast. And my question is, what do you see, multifamily in 5 years? Like, do you think it's gonna be, a big thing since, housing market is rising, and also, no, not market, but housing prices are rising, and, the inventory is going really low.
Yeah, I don't see multifamily going anywhere, ever. I think we're always going to have a need for housing. That's why I got into it. And I feel like it's a real safe asset class. You're always going to need housing no matter what. It doesn't, so depending on if the housing is going to get more expensive or less expensive, that's unknown, but we're always going to need somewhere to live regardless. So industrial is definitely a real, it's an asset class that has performed well, last several years as well. So yeah, either way, any of those two asset classes are, I think, great to be in.
Thank you.
Wow. Looks like we got another question from Marvin.
Hey Matthew, it's me again. I was just curious, what were some current projects you have going on right now, and what are they affected by anything such as like the global supply chain issues we've been having with COVID, or even the Ukraine-Russian war? Like, could you elaborate a little on that?
Yeah, so great question, and I haven't had any issues with the war as far as projects that I'm personally dealing with right now. There's always things to look out for when it comes to policy changes and different things with housing, especially here in California, that have impacted the way that we operate and manage property, our assets. And so those are things that, as policies change, we have to be aware of them, and we have to make certain shifts to what we're doing. And so that's an ongoing thing all the time. And with COVID, again, that was kind of an unknown thing, what was going to happen, how were collections going to be, the loss of jobs, and things like that. So those are things that, again, it's 24/7, it's not just you clock in and clock out. You're always anticipating, what can happen, like with the whole, a war in Ukraine, how could that potentially affect us? So I've been looking into that, but luckily there hasn't really been one as of yet, but we're always anticipating what could happen and how to mitigate those risks.
Yeah, no, that's a great way to sort of just always be on the lookout for things like that.
All right, and Matthew, I kind of want to turn it back over to you, and maybe we can, if you have any opportunities for us students, or if you want to kind of give us some final tips or advice, for us looking to graduate in the next semester, or maybe things to do or capitalize on while we're still in school. Maybe you could talk about any of those three things. We'd love to listen in.
Yeah, so as far as being a student, I definitely feel like being involved in clubs like this, like SMIC and REA, it's really it's really good information, really good knowledge. I would just plug in and network as much as you can right now. Reach out to myself for any questions after this, or seeing how maybe you can be of service. And I would just kind of get in the industry sooner rather than later, whether it's you see somebody that, hey, I want to, is there anything that I can help you out with, anything I can be of value? with, do you need help analyzing numbers? You need help with this or that, and kind of dive head first. And then that way you can kind of start to see these trends and get a better understanding, because it's really, at least for me, it's really like hard to kind of conceptualize something unless I'm actually in it and unless I'm actually doing it. And then I can kind of see, oh, okay, this makes sense now. This is why these people are looking after this or looking for this, these particular things. And you'll get a much better understanding, and you'll have, the experience to now go out and, put on your resume to go after, larger firms and things like that.
Perfect. I can name several people in this room that could be good research analysts for you. So we'll definitely keep in touch on that front. So Matthew, if you got any final words for us, or if anybody's any last questions for Matthew, I think we can wrap it up here and you guys can get to class and so on and so forth. So Matthew, if you have any final kind of concluding words, and we can wrap up the meeting.
Yeah, just that I think you guys are, definitely moving in the right direction, being involved, in the clubs, and just continue to learn as much as you can right now and get good at, I like hone in on your skill sets, whether it's analyzing, crunching numbers on spreadsheets, whether it's looking for good deals, whether it's, raising capital, whether it's getting good at, at different aspects of real estate or finance. Just really hone in on your skills as much as possible, and just try to be of value to, somebody, so that you can get real world experience in it as well.
Right on. All right, Matthew, we appreciate you for tuning in, and definitely have a good rest of your week.
Likewise. Thank you, guys.
All right. Super. Thank you, Matthew.
Thanks, Matthew.
Thank you, Matthew.
Right on.